thanks for joining me today. We'd like to talk about the what's going on in Q1. But first, can we just take a second and kind of look back on 2025? Kind of think about what happened there, maybe digest a little bit and think about how that might carry over. Domestic markets obviously did pretty well in 2025. International markets did even better. Do you think the drivers, or if you could lay out a couple drivers for the reason for international markets did better, and do you think that carries over into 2026?
No, great question, Mac, and it's good to be here with you today. We've worked together for a long time, and our first podcast, so looking forward to it. So, 2025 was a very interesting year. I feel like it was 3 or 4 years packed into one. U.S. markets finished up very strong, up roughly 18%, following 2 years up 20% each. So it had been a while since international markets had actually outperformed U.S. markets, but that was the case last year. I would say there's 3 primary reasons for that. One was the depreciation of the U.S. dollar. So as a U.S. investor in U.S. dollar terms, when your currency depreciates or lowers in value relative to foreign currency, that actually increases your returns. So that actually added about 10 percentage points to international returns last year. The other factor I would say was the re-rating of banks, predominantly in Europe. So European banks were up over 60% last year, and a lot of that was due to a multiple expansion as well as positive earnings. And then lastly, as pretty well known, fiscal stimulus was reinserted in the international markets, predominantly in Europe, driven by Germany, but increasing defense. So a lot of the defense spending and prospects for further government spending globally really helped buoy the international markets last year. Going into 26, we do expect international markets to perform well, whether or not outperforming U.S. markets or not, but I think it's more important to have international exposure, predominantly for diversification purposes. I don't think the dollar will decline quite as much as we saw in 25, but I do think earnings will be fairly solid internationally and start to see more of the domestic markets, predominantly in emerging markets, perform well and benefit from trade.
It does sound like, though, we might need to temper our expectations just a little bit.
I totally agree, Mac. We've gone 3 strong years in the U.S., a very strong year last year in non-U.S. equities. So history would tell us that that's not sustainable. Last year we did see kind of a transition as far as the composition of returns, transition more from a multiple expansion to earnings. And earnings this year for 26 are forecasted about 10%. And that's what we kind of expect. Roughly current estimates for returns in 26 for the S&P around 8 to 10%, but with much more volatility as there is more risk in the market.
So then focusing now on domestic markets.
Yes.
Just looking at the S&P 500, the Mag 7 has been really the hot topic that we've been talking about for a couple of years now.
Right.
The top 10 really companies in the S&P 500 make up roughly, I think, 40% of the market cap and are responsible for driving somewhere between 40 and 50% of the returns, specifically for last year.
Right.
Do you think that is sustainable?
Definitely, I would say definitely not. Obviously, these companies, the top 10 in the S&P 500, predominantly AI related. You saw in 23, 24, significant multiple expansion. And rightfully so, they were generating a lot of earnings, and last year did the same. But as we move into 26, earnings expectations are starting, they are growing, but the rate of growth is actually decelerating. So I think you're going to see more dispersion in those returns, and maybe the magnitude of returns are going to be lower as well. I think it will be a good thing for active management. I think there's going to be a much more discernment between winners and losers than what we've seen before. Before, it was more of a tide was raising all boats if you had AI related to your name. And I think that environment's starting to change, quite frankly. And recently, you've seen that in the software industry, where you've seen software companies really sell off.
You mentioned AI. There's several things related to AI going on as far as the news, as far as the market is concerned. One of the things that I've been seeing lately is a lot of the AI companies are now taking out debt. They're coming over into the credit markets, right? What about, you've covered fixed income for a long time in your career. What are some of the things in the fixed income space that you think are interesting in 2026?
Yeah, no, great observation, Mac. Great question. One thing that we are seeing with the AI-related companies, they've been funding a lot of their capital expenditures with existing cash on their balance sheet. And as this CapEx kind of arms race continues, you're starting to see these companies issue debt in the corporate bond market. So they're starting to take debt on the balance sheet. And again, that is another reason why earnings expectations are starting to decline, because now they're going to have interest costs associated with their business. So what we are seeing in the bond market is valuations very, very expensive, and especially in corporate credit. And I think the asymmetric risk is really to the downside, as risk premiums could widen in the event there's any kind of hiccup or problems in the credit market. But one thing that we are seeing, roughly 1/3 of corporate issuance last year was related to AI-related companies. So we were talking about concentration in the equity markets, now you can very easily get the same exposure in the credit markets or the bond market. So it's very, as an investor and an allocator, you have to be very careful that you're not duplicating your exposure, both in equities and in bonds.
Right. And, talking about the public credit space.
Yeah, you've seen a lot on the credit side.
Yeah, on the private credit space, which is kind of near and dear to my heart. We've been hearing about a private credit, quote unquote, bubble for several years, and when that would come, right? Private credit, traditional private credit, first lien, the credit that we think of as safe and secured, has gotten you double-digit returns for a while now, right?
Right.
I don't personally think that's sustainable. I don't necessarily think there's a bubble coming, but there's been some headlines literally this week about some of the bigger private credit shops that have run into some problems. They've had to shut off redemptions for some of their investments, and so hopefully that doesn't carry over. I think one of the things that we believe here is that that's a really good reason to play in the smaller, in the true lower middle market credit space instead of in the mega cap credit space. So that's something that we've tried to do, and some of the that's a principle that we try to really stick to, is we look for guys that are that are smaller, that are flexible, that are not doing syndicated deals. Some of the true senior secured type stuff, but on a smaller scale is what we tend to look for here.
Yeah, I totally agree. I think not only the type of deal, but the structure of our deals is a better match using the capital call type of structure, where the longevity or the long duration of the asset is a better match with the actual liquidity. So there's not a liquidity asset mismatch in our structure.
So, new Fed chair,
yes,
coming in May, I think.
I believe May, yes.
I think people have a pretty good idea of who it's going to be, but no matter who gets appointed to that chair, they're going to be in line. We think they're going to be in line with President Trump's agenda. Is that a good thing for the markets?
Yeah, no, great question. I think if we back up, I think you said it well, regardless of who gets nominated. I think there's the main primary thing that everyone globally is concerned about is Fed independence from administration.
Right.
And it does look like, based off the nominee, that will continue to be the case. And also, the other thing to keep in mind as an investor that the chairperson is just one vote on the committee. Now, that person might have influence over the entire committee, but their vote doesn't count more. So you have other people on the committee that will have their own independent voice as far as the actual decisions that are being made by the Fed. I think the other issue that is important, that the Federal Reserve only really controls short-term rates, Fed funds rates, so borrowing rates on the short end, yes, but a lot of the administration's focus has been more on the 10-year, which covers borrowing costs such as mortgages and things like that. It's very difficult, if not impossible, for the Federal Reserve to have a direct impact on the mid to longer term rates.
So the longer term rates, they're affected more by the market.
They're definitely impacted more by the market, more by inflation expectations, growth expectations, and quite frankly, in today's world, the risk premium associated with the amount of debt that the U.S. Government has issued.
Okay, another phenomenon that I'd like to touch on: the K-shaped economy.
Yes,
most people are familiar with that. It's made some headlines, but some people are not. For the people that are not familiar with it, it's basically when the economy is doing well overall, but it's because the top 10% of earners are on an upscale, and then the rest of us are on a downscale as far as earnings and as far as earnings potential and earnings power. What do you think about that phenomenon? Is that sustainable?
Yeah, no, we've talked a lot about sustainability, and it's because everything has been, despite all the noise in the economy, geopolitically, things like that, things have just been going straight up. But as a result of that, we are, or have been in this K-shaped economy. Some call it Wall Street versus Main Street. And if you look at the upward arm of the K, that's really the stock market and the economy. And that has really just gone straight up, quite frankly, over the last 3 years. But if you look at the downward shape of the arm of the K, that has to do with consumer confidence. And going back to what you were saying, roughly the top 10 to 20% of households with top income are driving over 50% of the economy's consumption. And so what that is doing is roughly 80% of households are living more day to day and hurting to get by. So you will see more about affordability coming up with midterm elections coming up. Trump administration is definitely focused on that. But the thing that I think people have missed in 25 is the fact that we're seeing this rapid economic growth, but we're doing that with productivity, but at the same time, there's negative job growth. So you're having economic expansion, upward equity markets, but at the same time, there's less jobs.
Yep.
And so that's what's creating this kind of K-shape, right, where consumer sentiment has been falling. And I think there's a lot of concern about job displacement through AI.
So to tie it all back in,
yes.
Okay, so now new Fed chair, we're talking about the K-shaped economy, talking about midterms.
Yes.
What role could interest rates possibly play in getting, in straightening the leg that's going down and straightening that out and getting it back to going in the right direction?
Yeah, I think the big thing that will help or could help kind of the lower on the lower income or the middle income consumer would be controlling inflation, and also the fact that real wages have not kept up with inflation. So if you look at the average consumer, a lot of the things that are important to them, what I call needs inflation, are actually higher than the inflation rate that gets posted on a monthly basis. So if you look at medication, healthcare, higher education, insurance, taxes, all those things, housing, all of those things are increasing at a higher rate. And we've seen very sticky service inflation, which is really related to housing. or shelter. And that's been very difficult for middle to lower income. So the people that are the income levels that are already in a house or in housing, they've seen their house appreciate and they're benefiting from that. But if you're not in a house, it's becoming much more difficult, especially for first-time homeowners, to actually purchase a house. And I think the median age now is 38 years old for the first-time home buyer.
Wow. Thanks, Matt. Thanks for joining us.
Mac, as always, I love spending time with you, and thanks for your time today.
All right. See you soon.
All right.